Axis Bank's Q1 was steady but devoid of the sparkle of larger private bank peers. While trading losses dragged down the pre-provision profit, lower provision on improved asset quality shielded the headline profit number. The good news is the interest margin improvement that was partially aided by loan mix change that suppressed loan growth. The bank nevertheless continues to drive growth in its focus segment. Deposit growth, which is a traditional strength of the bank, warrants attention for the next leg of growth. Improvement in return ratios is also a welcome development. The bank has a focused strategy to improve margins, drive profitable growth to reach its aspirational ROE of 18% in the next 3 years. And in this context, we appreciate the investments made to improve productivity and efficiency that might be keeping cost-to-asset ratio elevated. The valuation multiple is at a discount to larger private peers by close to 21% and will continue till profitable growth translates into intended return ratio expansion. However, with the market increasingly getting cornered by few large players including Axis Bank, we see good earnings growth ahead that makes it a strong candidate in the long-term portfolio. The 667 crore trading loss due to mark-to-market impact on corporate bond book dragged down the NII, which got some support, of course, from the expansion of NIMs. Elevated costs also contributed to lower pre-provision profit. Now, thanks to improved asset quality and consequently lower provision, the reported profit was respectable. The bank has guided to reaching its intended margin level of 3.7–3.8%, and the first glimpse of the strategy was visible in Q1, with NIMs expanding by 11 basis points sequentially and 14 basis points year-on-year as the bank deliberately changed the composition of its book by shedding low-yielding corporate assets and also got partial benefit of repricing of its book with rise in rates. Axis Bank intends to reach its targeted NIMs with improvement in quality of deposits, higher share of rupee lending versus overseas dollar lending, uptick in share of high yield lending and decline in the share of RIDF that carries a negative spread. Now, this should be the key driver for improvement in return ratios and continues to be a key monitorable. After showing a growth of over 15% in FY22 advances, the growth has moderated to 14% in Q1 with a slight sequential degrowth as the bank deliberately shed low-yielding corporate assets like I flagged off. The retail book has grown well, especially the unsecured piece that has a low share of 21% in retail. Unsecured had a 21% share in retail disbursement in Q1 compared to 18% in the preceding quarter. With adequate capital and provision, growing the unsecured book to improve lending yield is one of the key components of the bank's strategy. Consequently, the risk-weighted assets to total assets has moved up to 65% from 61% at the end of the previous quarter, but not very worrisome at this stage. In the banking sector, the player with the best deposit profile is clearly in a vantage position. For a long time, deposit was an area of strength for Axis Bank, but the market has turned intensely competitive. And for Axis, which ended last fiscal with a deposit growth of close to 18%, growth slowed down to 12.6% in the quarter gone by, with the bank running a very high credit-to-deposit ratio. While the low-cost CASA on a daily average basis has grown well and the bank has maintained CASA ratio at 43%, it seems to be struggling to grow its retail term deposits. Now, this should remain an area of focus, and a successful execution could be a strong pillar for growing the asset book profitably without compromising on quality. In Q1, slippages were lower than recoveries. Gross slippage ratio at 2.05% declined 210 basis points year-on-year and 33 basis points sequentially. Consequently, its reported gross NPA and net NPA were sequentially lower at 2.76% and 0.6% respectively. At the end of Q1, the bank's provision coverage stood at a healthy 77%. The bank holds cumulative provisions of 11,830 crores. It has a minuscule restructured book of 3,400 odd crores and carries a provision of 24% on the same. Axis Bank is adequately capitalized and is walking the path of a profitable growth with an endeavour to reach 18% ROE by FY23. Its subsidiaries are also gaining traction and are not yet factored in our valuation. The stock trades at a discount to its private sector peers at 1.5x FY24 estimated book. Long-term investors should focus on the decent earnings trajectory that lies ahead. Of course, like any other company, there will be some key risks to watch out for. Number one, the unexpected future disruption due to macro uncertainty which could disrupt growth and a substantial worsening of asset quality.